from a tax point of view, it's employers who are coming in for the real hammering here. So smaller employers, obviously, if they've got a relatively small wage bill, the increase in the national insurance employers' allowance will soften the blow, or actually leave them in a net positive situation compared to where they are at the moment. But I did and my maths is terrible, so don't rely on this or quote it. It's not great for a tax person, is it? But if you've got somebody on 30,000, I think the current NIC bill at 13.8% and a nil rate amount of 9,500 is around 2,800 for them. That'll go up to 3,750 for an employee on 30 grand a year. And for somebody on 60 grand a year, it's currently just shy of 7 grand. That'll go over to sort of 8,250. So they're, for people with businesses with large populations of employees,
1.5 to 3% increase.
It's a massive, really, really significant cost. Which, when you think that you've now got, as Sarah said, the national minimum wage now, going up by 6% but also aligning it so you're going to ultimately have a single national minimum wage for all adults, means that, again, employers are just bearing more and more of the burden here, and how's that going to impact on people's recruitment decisions over the coming years? And ultimately, one way or another, that is going to find its way to the consumer through increased prices, because businesses are going to look to adjust prices or reduce employee numbers in order to actually maintain their profitability. From a business exit point of view, valuation is going to be impacted because profitability is going to be down as well. So there's a whole raft of kind of, hopefully consequences that have been thought through from these changes, but I'm never completely convinced just how far the thinking process actually goes. That may be unfair, but I've watched enough budgets over the years to be fairly confident it doesn't always go as far as it should. The other big ticket items are obviously capital taxes. And capital gains tax, as I think a lot of us probably had got to suspect, it could have been worse. It could have been a lot worse. Sort of 39% was a number that was obviously floated out there just to see what the reaction was. The reaction was, absolutely appalled, and therefore we've now got a top rate of CGT of 24%. I've just had a quick check on the Treasury website, and again, this is just an initial take, but I think that's effective from today, the 24% rate and the 18% rate for basic rate taxpayers as well. The 18% rate, that's a significant increase in percentage terms, but the actual level of gain that impacts tends to be quite low, because it's only really relevant where people have got income below the basic rate threshold anyway. The positive news, business asset disposal relief, hands up if you're looking at Sarah's checklist there. I thought that would go from today. So we've still got it, and that stays as is until April. But then it goes up to 14% next year and 18% to align with that new lower rate of CGT. So there's still some reward in terms of reduced tax rates for people selling entrepreneurial businesses. And I think, potentially, let's be honest, BADR, in terms of what it actually saves you, that 4% increase for any individual is a maximum cost of £40,000, right? Because it's the lifetime limit of £1 million at 4%. So for somebody who's doing a pretty significant deal, that's not something you're going to sweat over. But if somebody's selling their business that's built up over years and they're only expecting to pay 100 grand tax on, say, £1 million gain, to suddenly have another 40 grand going out as a consequence of this, and then 18 grand in 2 years' time, that's a big old hit. That is something that is going to hurt. But is it actually? I think, again, it's just about, and Charlotte in the room is very good at saying, just reset your expectations and understand what that means in terms of what you actually have to achieve in order to get back to the same net figure that you would have beforehand. So at least we understand it now. We know what it is, and it's nowhere near as bad as it could have been. So I don't know whether the queues of people at Manchester Airport waiting to get on the flight immediately after the end of the speech have dissipated to a certain extent, perhaps. So again, on capital taxes, I I can't remember. I think I was probably at school the last time that the inheritance tax nil rate band was increased. So it's been 325 grand for as long as I can remember, and it's going to stay that way for a while. Yeah, still, and it's a classic example of what people like to call fiscal drag. Just by virtue of the rate not moving, it drags more and more estates into IHT over time. And for those estates that are over, it increases the amount that they're exposed to IHT. The big ticket items there, inherited pensions into IHT, that's a massive change for particularly people with big pension balances where they've relied on being able to pass that down to the next generation, inheritance tax free. I think from April 27, that's going to be in your estate from an IHT perspective. Whether that changes people, I mean, there's a few people from wealth management businesses in the room. I think it'd be interesting to get their perspective on over time how that's going to impact on people's strategies in terms of pension savings and inheritance and stuff like that. The other thing for the business owners in the room, I don't know if we've got any farmers in the room who are affected by agricultural relief, but there's certainly business owners in the room who are going to be affected by business relief, and that's again a big change. So the expectation up to date has been that if you own a trading business, you can pass that on in your will, and it's entirely inheritance tax free. We've now gone to this situation where effectively, if it's worth up to £1 million, it's still inheritance tax free. If it's worth over £1 million, there's going to be 20% inheritance tax on that excess over £1 million. How that's going to be funded is a really interesting and challenging question. There may be no option but to raise debt on the business or even sell the business in order to pay the IHT liability. The whole point of BPR was to avoid that impact by people having to sell businesses in order to fund the inheritance tax liability. I would expect there's certain assets like property, you can spread the inheritance tax paid over a number of years. I would imagine that will be the case on this, but you are still going to have to find the cash to pay that. So again, in terms of people's succession plan, if it is a family succession type situation, it's going to radically change the way that they should be thinking about how they're going to pass that business on.
Yeah, that's usual for this kind of thing.
BADR doesn't. I think that's still till April, but the rates are going from today. I think other things that kind of stuck out for me, the corporate tax roadmap, and I always a little nervous when people say they've capped the corporation tax rate at 25%. Well, it's capped at 25% at the moment for businesses making over 250 grand a year. 19% for businesses who are making 50 grand a year. Capped at 25% implies to me that there's wriggle room potentially for them to increase that 19% over time. And I wouldn't be surprised if we get back to a unified rate of corporation tax at 25% over the lifetime of the Parliament. What else? No changes, no extension to the freezers in the income tax threshold. So from 28-29, it's going to go up by inflation as it has done in the past. But 28-29 is a long time away, and nothing's forever, is it? So there's every possibility that this time next year they might say, well, actually we need to freeze it now for another couple of years. Cool. You may think I'm cynical, but you don't do tax for as long as I do without becoming a little cynical, unfortunately. The other thing that in one sense is heartening, I think, is this commitment to modernise HMRC systems. Now, if I could, a bit like BADR, Entrepreneurs Relief, I've had a pound for every budget where they've said they're going to improve HMRC's performance, and we've seen absolutely no impact from that performance improvement. They're talking about more compliant staff. They're going to go after umbrella companies, which I think is these are companies where effectively they almost force people into behaving, treated as if they're self-employed effectively, and they keep all of the NIC savings. So it is pretty insidious, some of that stuff, when it's done badly. So I'm, in a sense, I've got a degree of sympathy with going after people who are promoting tax avoidance schemes. It's just where there's always a slight nervousness about where that line about what's legitimate tax planning as opposed to what tax avoidance is and where that actually sits. And over time, you've definitely seen HMRC trying to push that line closer and closer to what we would consider to be perfectly standard, legitimate tax planning.
Yeah.
Can
I add a little bit to that?
Of course.
On that point as well, I think the other challenge here is these. Well, the employer NI changes that we've seen have essentially increased the tax differential between employment and self-employment or worker status gap. So the government has increased the incentive for you to try and come up with a way of disguising employment. Simultaneously, of course, the next bit of legislation on the whatever the working conditions bill is like to be called, wants to abolish worker status.
Okay.
So there's going to be an interesting bit of interaction about how on earth all of that goes. Abolishing worker status from a sheer economics point of view is a really good thing to do, because it's from a legal point of view, it's odd because it's a case law thing. Parliament has never called for a worker thing. It's a result of judicial action. So that needs tidying up, but that's going to be really hard, right? I mean, expect very long consultations about how to abolish. Because if you're going to abolish worker status, you have to make the employment, self-employment distinction crystal clear. And you've just provided a fiscal incentive to try and route people into self-employment, essentially. So there's going to be some mess around that.
I mean, it's a mess already at the moment for anybody who's trying to navigate. So you may have heard of what generically known as the IR35 rules, which is this distinction around somebody who's working for their own through their own company. Are they actually a contractor, or are they really an employee? And we've had Heinz 57 different varieties of tax cases, largely around BBC news presenters, but also high-profile sports people. And it is virtually impossible to kind of draw a line and say, well, okay, I understand why that one was treated as employed, whereas this one wasn't. And yet employers, over who are sort of medium-sized entities and above, are expected to make a judgment around that and decide whether this person who's providing their services through their own company is actually a deemed employee or not, when even judges in the High Court and the Court of Appeal and the Supreme Court can't work out how that works. So to Christian's point, we've now got a much bigger incentive for people to say, well, do you know what, I'll give it a go, because that's going to save you 15% employers' national insurance rather than 13.8% employers' national insurance. So we've turned what is already muddy waters into a swamp, as far as I can see. So that is going to be a real challenge. Interesting one, they're going to increase the interest rate on late pay tax. There is a tendency for certain businesses to treat HMRC as though they're a bank, because their lending rate's actually lower than the high street banks. So I think from that perspective, that's probably actually a reasonably sensible change, because we don't want to give people a reason. If the HMRC's interest rate is less than your cost of capital, then why bother paying your tax? You might as well borrow off HMRC. So I think in one sense that's not necessarily a bad move. There were one final thing, and sorry, this is a little bit eclectic, I know, so apologies, there's no particular thread. I just looked in the documents, and there's a mention about some anti-avoidance rules about preventing people from extracting untaxed funds from their companies. Now, I don't know how you can extract untaxed funds from you, so I'm obviously missing a trick here. So, but apparently they're going to bring some anti-avoidance rules in to stop that. Now, I wonder whether that relates to things like we've seen a raft of MVLs, where people have built up cash in, many members' voluntary liquidations, where people have built up cash in businesses and are now taking it out at capital gains tax rates by liquidating the company. There are some anti-avoidance rules around that already, but they're not well enforced, and they're quite easy to navigate around. So it could be that. It could be things like, I don't know, alphabet shares could be something around that. We know that that's something that HMRC have never really looked at in the past, but you're going to have to start reporting on differential dividends on share classes and things like that in the near future. So I do wonder whether we're going to see a tightening up around some of this stuff, which could impact things like family investment companies, for example. So there's a classic taxman's way of trying to avoid getting into too much detail. The devil is all going to be in the press releases. So the one good thing is I've got something to do while Mrs. Brown's watching Married at First Sight this evening.